going on, YouTube traders and investors? Welcome back to the channel, Bennett TradingAnalysis.com. It's Thursday afternoon, January 13th already. My goodness, 2022. We're into the new year. Happy New Year. Happy holidays. Let's get into it. So when we met last, we talked about the idea that instead of seeing the traditional seasonal Santa rally, as many like to call it, that perhaps we were up against December distribution. We're now into January, and markets have been a little bit shaky from the November 22nd high. Now, there's no question that we've seen a rotation into value stocks and sectors, but does that mean the growth trade is dead? Absolutely not. In fact, looking at the chart here together, from that November 22nd high, markets moved lower into the December 3rd low. If November 22nd was the end of a motive wave, as we call it in the world of Elliott wave, we would have anticipated a motive decline. We had a corrective decline. From there, we rally all the way back to the December 28th high. Again, we do so in 3 waves. From there, we're down in 5. The question now becomes, is in fact the Monday, January 10th low the end of the correction, or do we have further to go and further work on the downside? It's entirely possible that we do get a move all the way back to the October low, but I'm going to say it again. I'm not bearish the markets. We have seen the rotation into value. If I take you over here to the Optimum platform, I brought this to your attention on the Wednesday live stream show, the fact that we were seeing a growth and value rotation dynamic that was very similar to the one we saw going into 21. That sparked a rally for value, but that does not necessarily mean you should be void of growth in your portfolios. In fact, relative rotation analysis is just that, relative performance. And as you can see with my expected 5th wave move in the indexes, the idea that value outperforms growth for that final 5th wave is not unheard of. So let's go ahead and get into it. Now, you might be asking yourselves, as we move off the daily down to the 30-minute chart, and let's just go ahead and go full screen on the charts. Looking at the 30-minute chart here, for the Nasdaq, and let me take you over to the count that perhaps suggests the low is in. From the November 22nd high, as mentioned, down into the December 3rd low, all the way back into the December 28th high, and now 5 waves lower. In fact, there was even a possibility December 20th was the end of the correction. So what happened? What did the markets see? What news did we get? What sparked the additional volatility? Well, it was none other than the December Fed minutes release. And in fact, as you can see right here, January 5th is when we got those minutes. Now, typically, for those of you who are new to the markets, the Fed minute release is generally a non-event. It typically just echoes the sentiment that was communicated in the actual meeting statement and press conference. But this time, the minutes included a few surprises that had investors, in my opinion, overreacting to the downside. Now, we all knew that, as the economy began to recover from the coronavirus pandemic, that we would see central banks move away from the easy money policies of the last 2 years. It's been record-setting. And that's already started. There's no question about that. Back in November, the Fed began tapering their $120 billion monthly bond and mortgage-backed security purchases, and they doubled that to $30 billion in December. But the minutes from the December meeting read even more hawkish. And the Fed seems to no longer be communicating a wait-and-see attitude, but instead has upped the ante in terms of expected rate hikes for this year. The Fed now expects 3 quarter-point moves in 22, another 3 in 23, and an additional 1 in 2024. In fact, markets are even pricing in about a 50-50 chance of a 4th hike this year. If I take you out to the CME Group's Countdown to the Fed tool, and we'll get to this other page in just a minute, keep that in the back of your mind if you're interested in the crypto space. But looking at CME Group's Countdown to the Fed, we're now pricing in an 83.1% chance that the Fed does move a quarter point in March. So additionally, or I should say originally, this was down somewhere in the 30s, started to push up into the 40s. Here we are at an 83% chance. In fact, there you go. Going back just 1 month to December 13th, we saw a 31.2% chance. So as the Fed begins to up the ante on the potential rate hikes, they also, in addition to increasing the rate hike path, the majority of committee members expect they'll need to begin balance sheet runoff following this year's hikes in the federal funds rate. Now, the future is obviously not written in stone. The pace of normalization is clearly going to be dependent on the pace of the economic recovery. And the Fed continues to suggest that they will be data dependent. So I'm going to say it again. For now, I continue to remain bullish, and I do expect that we will see a break to a new high in the Nasdaq as well as the S&P 500 before that larger 2022 market correction is possible. So let's get back to the charts, and we'll take a look at where we are now. So looking at a chart of the Nasdaq 100, we're going to go ahead and take you out to the daily time frame. Looking at the daily chart of the Nasdaq 100 going all the way back to the COVID low in March of 20, we began a kind of interesting five-wave rally. This five-wave rally did have a lot of overlap. It was not very clear where the corrections of the same degree actually were. And as a result, we've continued to view this as opportunities, meaning we utilize three-wave corrective retracements to position on the long side. And looking at those three-wave corrective retracements, let's discuss where they've actually occurred. So going back to the September high in 20, we retrace all the way to the September 20th low in three waves. This was the largest percent correction that we had seen from the March COVID low. We then rally in another 5 waves, correct in 3, rally in another 5 waves, pair up our blue intermediate degree wave 2 correction. Corrections of the same degree often tend towards equality. And then we get this big extended 5th wave. What I really like about this extended 5th wave is the fact that we have pairing of our corrections and our wave 5 being equal to 61% of 1 and 3. In addition to this, we can utilize an Elliott wave channeling technique, which takes the low of wave 2, draws a trend line from the low of 2 through the low of 4, and projects your parallel trend line over the top of 3. When you do that and you use that in combination with your upside fib objectives, you often are met with the resistance point where the markets do finally see a correction. So looking at this here on the daily, and also note our peak in relative strength, our RSI peak from post September 20 has been into that November area high. Also notice we're now getting clearly isolated corrections. This is typical of a third wave move. The characteristics exhibited in this breakout are very typical of a third wave move. So zooming in back on the daily chart, my alternate end of year scenario, which I introduced to you guys last year, suggested that instead of rallying through December and January, we would actually get a counter trend correction to the downside. It's still possible that Monday, January 10th inked out the low of the correction, but based on today's trading action, it's looking a bit less likely. Today's low in the market was met with a new low in internal readings, which often are kind of indicative of further downside and not the rounding out of a low. So this is our worst case scenario. Our worst case scenario suggests that we're contained in a complex correction. 3 down, 3 back. We did 5 down for the first leg of Y. We did a big B-wave retracement to the 618. And now, if we project a quality of C and A and look at that in relation to our wave 4 comparison to the wave 2 of the same degree, you'll notice 4v2 equality is at 14,390.60. What's interesting about that is the fact that it does have confluence with the previous 4th wave, in this case, of 2 lesser degrees. So we have a zone of support that is forming at 14,390 up to 14,693, and that's the worst case downside scenario in our opinion. From there, we do anticipate wave 5 setting in, and once we get maybe end of Q1, even out to middle of Q2, that's when we see the possibility for a larger market correction to set in. Now, looking at the Nasdaq in terms of suggesting the low is in, while it's possible, today's move has been pretty sharp. If in fact the low is in, this is 5 up to continue the trend. We're going to retrace and maintain somewhere between a 61 and maybe 78% retracement of the Monday through Wednesday rally. But if you see a move south of the Monday low at 15,165.53, that's when you've got to open up your mind to the possibility we go all the way back down into the 14K handle and perhaps even visit those October lows. So again, I just want to reiterate the fact that we continue to remain constructive on the markets. We do see the clear break higher in value going back to the divergence that it had from growth in December. That is most evident on the relative rotation graph charts that we've been using in our Wednesday strategy updates, or our Wednesday live streams. So we're not bearish. We're going to continue to look at this as a buying opportunity, as we do think it's going to present continuation on the upside. Once that move takes us into a new high that exceeds the November high, that is where I might become a little bit more defensive and open myself up to the possibility of a 15, maybe 20% correction. One of the charts that the structure from the COVID low is most evident in is in fact the chart of the Russell 2000. Looking at the chart of the Russell 2000, I continue to view this as wave 4. This could still take us further to the downside as the 38% retracement is at 1945, but I do feel this is a wave 4 finally pairing up to its wave 2. The chart of the Russell 2000, the chart of S&P Midcap 400, not as subjective as the Nasdaq and the S&P. So that's it for me. I hope you enjoyed the content. Hey, if you're interested in the cryptocurrency space, I would highly encourage you to check out an upcoming webinar. We've got a webinar taking place next Wednesday, January 19th at 3 p.m. Eastern. Alex is going to go ahead and lead this up. He is our chief macro and crypto analyst here at Trading Analysis. He does a fantastic job. Alex called the 2018, the December 2018 low in Bitcoin to within 20 points. It's pretty incredible. And earlier this year, actually last year now, I'm still living in 21, forgive me. But last year, when the markets were rallying, when Bitcoin specifically was rallying up towards 65 and 70K, Alex put out a zone of resistance and said, hey, not so fast. Everyone was anticipating that immediate move to 100,000. Alex jumped in there and said, hey, I don't think we're going straight to 100,000. I think we've got a haircut. We've got a wave 4 correction. And we saw over a 50% move to the downside in Bitcoin. So if you're interested, check it out. I would encourage you to sign up, tradinganalysis.com/webinar to get signed up today. Thanks again for tuning in. I'll see you guys on the next video update. Have a good one.